Hey, what is up guys, welcome back to ProTraderPath. I'm back with another video, and in today's video this is the fun part begins, where we are looking for the high probability and low probability entries. Now this is the fun part, but before I go to the fun part, you must have to identify where the price is within the higher time frame market maker model. What do I mean by that is, you have to identify that on the higher time frame, are we in a market maker sell model or we are in a market maker buy model. If we are in a market maker buy model, we are looking for a structure like this, and if we are in a market maker sell model, we are looking for a structure like this. Okay, so with that, let's start with the fun part. Now I know finding the higher time frame bias or narratives are pretty hard, and it's something that you have to master with the knowledge or information you can gather from whoever your favorite teacher is, or whoever is teaching you or giving you the best efficient way to figure it out. But with experience, it's all about how much effort and time you are putting into the chart. No matter how many live streams, how many hours of videos, how many different types of models that you are looking into, until you start to look for it by your own, nothing can help you. Now in my recent videos I have got some comments, please do it fast, make it fast, or help me figure out this sort of thing. Trust me, no information, nothing will work until you can figure it out by your own. So rather than spending time on a 8-hour stream or on a 5-hour stream, you should take the knowledge from the person you are following or you are willing to learn from, and you have to spend time any day, like any given day when maybe the market is closed or you are not trading or looking for trades. Of course, you should not be looking for trades until you have a set strategy, or if you until you know what you are exactly looking for. You have to find out a way to figure out what exactly you are looking for, what your strategy is, and how the strategy works, if it works or not at all. Okay, so regardless of what you are learning, so a lesson or a learning period will only give you the success that you are looking for when you will be able to figure it out or point it out by your own. So with that message, let's start the fun part. So once we find out or identify which side of the market maker model that we are looking in terms of the higher time frame, in this case a market maker sell model, now you have to ask question that where exactly we are sitting at. Are we sitting at the initial consolidation, then the first stage of the delivery, or the second stage, or have we meet our buy side of the curve objective, which is taking some buy side liquidity or reaching or retracing to a higher time frame point of interest? If you have reached there, or we still have room for that. If we have, or let's assume that we haven't reached to our higher time frame point of interest and we are just looking into the first stage of accumulation. So once we identify that, which is very important to identify, so you can always identify or look for that on your higher time frame chart. Look for the projections, the price action that happened already. So with the informations I have shared earlier, I believe that you will be able to see, or you will be able to find out where exactly we are sitting in terms of the market maker model and insert the buy side or sell side curve. Okay, so the step 2, once we identify where we are currently at in terms of the price delivery, are you on the buy side or the sell side, and if we have the room to look for entries or not, or if market has already delivered or reached to its objective. So once we identify that, now let's talk about the entries. Ideally or personally, I use 3 different time frames simultaneously, where I look for the higher time frame draw, which can be the buy side of the curve, where price is reaching for or what price is reaching for, the sell side of the curve, where the draw on liquidity is, to identify those sort of things. On the mid time frame that I personally use, I use the mid time frame to figure out at what stage of the delivery we are into. Are you on the first stage of accumulation or the second stage of reaccumulation? How far can we go from there? From that, or are you on the sell side of the curve or the distribution leg, first stage of distribution or the second stage of distribution? So that's the mid time frame that I usually use for, and the lower time frame which I usually use for to enter and to place my stop loss. However, the reason for your entry and stop loss should be based on your mid time frame, which is also redefining your stages, right? So the reason for that is because a higher time frame array or higher time frame PD array is stronger than a lower time frame PD array, right? And the algorithm will reach for the higher time frame array or level over the lower time frame array or level. Now about the three different time frames that I have mentioned, or I'm trying to give you guys, it's only depending on the type of trader you are. You have to figure out what type of trader you are. Are you a position trader, a swing trader, a short-term trader, or a scalper? So for example, if you are a position trader, you can use monthly chart as your higher time frame, weekly chart as your mid time frame, and daily chart as your entry time frame. If you are not a position trader, if you are a swing trader, you can use weekly chart as your higher time frame, daily chart as your stages or the mid time frame, and hourly or 4 hours chart as your entry time frame. If you are a short term trader, you can use your daily or 4 hours chart as your higher time frame, your 1 hour or 15 minutes chart as your mid time frame, and a 5 minutes or 1 minute chart as your entry time frame. Again, it's solely depending on what type of trader you are and what your broker allows you to do. If you are a scalper, you can go hourly as your higher time frame, 15 minutes as your mid time frame, and 1 minute or 5 minutes as your lower time frame. Again, it's solely depending on what type of trader are you and what your broker is allowing. For example, if you are trying to get funded or trade with Top Step or Apex, they will close your position at 4:15 p.m. New York time. So you cannot hold the trade until the next day or next session or whatever. It will close your position at whatever profit or loss you are seeing on your position. It will close automatically at that stage. So for that reason, I'm a short term, or you can say scalper. Okay, so I am a short term trader or a scalper. So yeah, I mean, it's completely up to you. Don't get influenced by what I just said. Let's start with the first entry. Once price leaves the initial consolidation on a market maker sell model, the buy side of the curve, once price leaves the initial consolidation high and the expansion happens, price will often refer back to the consolidation range, a PD array inside of that, a fair value gap can be there, or a order block inside of the initial consolidation range. That is also your premium and discount array. If you project a fib from the low to the high before the retracement is happening, you will find that it's sitting below the 0.5 level or the midpoint of the entire push or entire leg. Now, as a bonus tips, a high probability order block, or the highest probability order block I should say, since ICT said that way, will most often sit inside of the equilibrium level or at the 50% level of your initial consolidation range. So at the middle point of the initial consolidation is where you will find your high probability order block. That can be your first entry. Sometimes what price can do is it creates a breakaway gap. Instead of coming to the initial consolidation level or initial consolidation area range, it can tap into the other fair value gap, create a breakaway gap or bag around the lower portion or inside of that initial consolidation range, and tap into the upper fair value and then expand higher. Now in that case, I have already talked about why, when and where exactly you can expect a breakaway gap to happen, what can be the reason. Now there is just another thing to add, that usually what happens is, if a fair value gap is sitting below the equilibrium level or at the equilibrium level, where let's say this fair value has some portion like this, and there is a inducement liquidity or some short-term swing lows above the fair value or at the level of the fair value has formed, price will retrace back below the equilibrium by a tick, or it can go even little more, but just for the sake of the understanding, price will trade into that equilibrium level inside of that fair value, take those inducement liquidity. Now what is the inducement liquidity? Prior to a move, market has created some short-term low or some equal lows around that area on the lower time frame. When market retracing back into the equilibrium level of the PD array, which is premium discount array, market will take that liquidity and trade back to the equilibrium or below the equilibrium, then it will start to go higher. So in this case, what you will do is, your entry you can look from this fair value. However, the best idea is to look for an entry either at the equilibrium level or a tick or two below the equilibrium level. So mostly market reaches few ticks below the equilibrium level, takes the inducement liquidity, and as I shared or showed earlier on my channel, that once market creates the inducements and once it takes the inducements, the expansion is pretty quick and pretty aggressive. So you can expect that to happen, and your first entry can be inside of the range when price retraces back. If you can figure out that okay, I have nothing to worry about regarding a breaker block around that area or regarding a consecutive order block that can start from here until the low, so the consecutive order block, nothing like that. So I already explained where and when you can expect a breakaway gap to form or happen. So if you have the idea about when and where you can expect the breakaway gap, you can look for entries from that fair value gap. So that's the first stage of accumulation where you can look for an entry. Now let's talk about the second stage of accumulation, or the next entry that you can have. So the next entry can be inside of the expansion leg after the first stage of accumulation happens, a fair value gap. Again, if it aligns with the time and the price, and if there is any inducement liquidity, this can confirm the high probability. And as you already know how to grid to your projected terminus or the drawn liquidity from the low to that area, if the fair value gap aligns with that grid level or come close to the grid level, at 50% level, if there is a fair value, you know what to expect from that fair value and what usually that fair value stands for, which is the measuring gap. And you can measure if your high time frame point of interest or the drawn liquidity is in alignment with that measuring gap or not. I have shared every information regarding that, so you are expecting price not to retrace here. However, around that 75% level, between 0.5 and that 0.75 level, we will have a fair value gap. Now with time and the price delivery, you will find a high probability entry around that fair value. The reason behind that is, again, if you have a short-term liquidity sitting around the fair value area or like above the fair value area, you can use that inducement liquidity and the fair value to enter into your trade until it reaches to your higher time frame point of interest, and that should also complete the buy side of the curve. And as I said earlier, that the second stage of reaccumulation, when the reaccumulation happens, this final leg is very explosive and very energetic towards the draw on the liquidity or higher time frame point of interest, so that the retail traders or the regular traders get scared to look for the sell short. Okay, so I hope with the grid, with the alignment, now this is a drawing, of course usually what you see is around that 75 level the fair value gap is aligning something like this way, okay, like very close to that 75 level, maybe right on top of that level or right below that level you will find your high probability fair value. And as I said, if there is a swing low or a short-term liquidity in terms of inducement is sitting around that area, it will be even higher probability in terms of your entry. So let's say this is your higher time frame fair value gap that you can see or you have identified as your drawn liquidity. Inside of that higher time frame fair value gap, if you have a buy side liquidity in the form of old high sitting, and often what smart money or price will do is it will kill two birds in one shot, which is taking the liquidity, rebalancing the imbalance area or the unfilled area, and then deliver. So the first entry, which is the most aggressive entry as well, again that depends on your own preference and your own comfort zone, how comfortable you are in terms of taking the entries. If you are too aggressive or you have been looking into entries like this, this is where your turtle soup entry will form. So the turtle soup is above the buy side liquidity, inside of your imbalance you are taking an entry. So this part is unfilled from the previous price action. Market will take the liquidity, it will trade the premium portion or premium end of the fair value gap. Remember, every fair value has the equilibrium or consequent encouragement level, the midpoint, the lower which is the discount end of the fair value, the upper portion which is the premium end of the fair value. So it will reach for the premium end and you can look for a entry above the high as your turtle soup entry. Stop loss has to be above your higher time frame fair value gap. Now a stop loss, again you can look for the confirmation or levels on the left side of your chart based on your risk management and your price action. So entries can happen here as your turtle soup. Now this is a high risk entry, so often even if you are trying here, you will try, or I would suggest you to try with low risk or less risk than the usual. Now that's the first type of entry on the sell side of the curve that you can take. The second type of entry, if you are little conservative, you can wait until the smart money reversal or the change in state of delivery happens. After market reaching to that unfilled area, if you find your smart money reversal here, as I shared earlier, that once the smart money reversal or change in state of delivery happens, that is where you will have your order block, and usually price will trade back to the lower portion of the opening price of the highest up close candle, the candle that is responsible for the change in state of delivery, and from there market will continue lower or give you the displacement that you are expecting. So the second entry can happen when the change in state of delivery or a smart money reversal is confirmed from there. This is also a riskier approach to the market, but since you are waiting for that smart money reversal and the confirmation of the change in state of delivery, this entry comparing to the turtle soup entry is less riskier. Here you can catch almost the high of the day as your sell side of the curve or as your entry point. From there the displacement, the market structure shift will happen, and if you have your market structure shift with the fair value available, I have already discussed on my previous lesson that when you can expect a fair value to be retested and when you can expect any other fair value to act as a breakaway gap. So the third entry will be forming inside of your breaker block once the market structure shift is confirmed. So let's say you have a breaker block here, and if there is any fair value gap aligning with your breaker block, this is where you will have the highest probability entry for the sell side of the curve. Here you can take or this is where your A plus setup will form. So you are looking into a liquidity graph from recent swing high, also a previous or old swing high inside of a higher time frame point of interest. You figured out the smart money reversal or the change in state of delivery. You got your fair value when market was giving you the market structure shift or change in state of delivery during that leg, or the expansion leg to the distribution side or the sell side. This is where you will take most of your risk, and you can identify where to put the stop loss, since I have already talked about your entry and stop loss on this side as well. This is where if you have a breakaway gap, it's good to put the stop loss above the breakaway gap, or even you can put your stop loss at the high, which in my case I really don't look into that, because when I have a breaker block, a fair value gap, a breakaway gap, there is 3 level of defenses. I would love to put my stop loss, the candle that created the breakaway gap, I would love to put it there, because according to ICT, when 3 level of defenses are violated, the next target is your ass or your back. So I don't want to set my back over here. I would love to set my back above the breakaway gap. So if there is another fair value gap that I can expect, and again I have shared it why and when I can expect a breakaway gap because of the reasons that I have. So a breaker block, maybe consecutive order block, another fair value gap, lot of other things can happen during the market structure shift. With the confluences with my previous lesson or understanding of the previous lesson, you can look for your entry, the highest probability entry around this area, and your stop loss can be the breakaway gap candles high, which can be somewhat around this area, or simply at all-time high, or the high of the day that you are expecting price will not revisit. That's up to you. You can even cover the mean threshold of the highest up close candle or the midpoint of the highest up close candle as your stop loss, because the order block mean threshold has, or the opening price and the mean threshold, the order block itself has the power to send the price lower as long as there is a fair value gap available on the leg. So that's your third entry. So again, to recap, the first entry is above the buy side liquidity sitting inside of your higher time frame point of interest in the form of old high or old buy side liquidity, and there is still the portion unfilled, so you can put there as your turtle soup entry. The second entry can be after the change in state of delivery happens, you can enter from that highest up close candle's opening price, and often price will trade back into the opening price of that candle and continue lower. And the third entry, which is also one of the highest probability entry of the entire thing or entire market maker model, is after the confirmation, where you can have a breaker block aligning with a fair value gap or right above the breakaway gap, or partial or partly aligning with the fair value gap. You can enter from that fair value, then look for the continuation lower. This is the third entry. Now the fourth entry is what ICT said for the rest of his life he will look for. If he has to trade only one entry or one model for the rest of his life, he will look for the second stage of distribution on a market maker model. Now in this case, I have already shared about the distribution block, which is the lowest down close candle or candles inside of your first stage of accumulation leg, which is this area. And if there is a fair value aligning here inside of that fair value, along with that, if the time, which is the silver bullet, remember what I shared around this area, the silver bullet, this is mostly a very aggressive move towards the downside, or the highest speed of the move will happen around this area, and ICT said this will be the level or area where you will be taking most of your risk once you identify the market maker model properly and identify the levels properly. And at the same time, remember the preference and the drawn liquidity. this thing, although my drawing is not perfect, but I hope you will understand the fact that this thing will align between the 50% and this, and your measuring gap will also align with the 50% level. So there will be a measuring gap that price should not or will not trade at all, and then you will have your fair value gap. So what I mean by this is, if you know your preference, you will look for the fair value around that standard deviation or the 0.5 to 0.75, in between that range inside of your distribution block. And if the time or the alignment happens within the time, any silver bullet. Okay, so if you are trading the London session silver bullet, you can look for that into your London session silver bullet. If you are trading the New York session, you can look for that inside of your New York AM or PM session, depending on where exactly you are sitting in terms of the delivery. Okay, so this is where you will find the highest probability entry in terms of your last entry, and the target should be initial consolidation low, where you can take partials or close partials and leave the rest runner until the higher time frame point of interest of the fib range. Wherever the price aligns on the fib projection, you will take the final profit around that area. So also this is where the second stage of market maker sell model, the distribution second stage, will occur. Now before I finish the lesson, think this way: you are bearish on the higher time frame, you are looking into a market maker sell model. So where exactly are you going to use your highest risk, or in terms of taking your entries, which side is the high probability out of all the entries I have shared? So the sell side of the curve is where you are willing to take the highest risk, or the A plus model or setup of your own strategy or entries will form on the sell side of the curve when you are looking for a market maker sell model. So in that case, even though you are identifying the buy side of the curve or price is giving you that, I would highly recommend you to not risk the exact same amount that you are risking on your sell side of the curve. Risk less than that on the buy side of the curve, just to be part of the market. If you can even ignore that, it's even better. But if you are risking, risk less than what you usually risk when price is delivering according to your analysis or according to the direction you are aiming for. I hope that part is clear, and with this I have completed the market maker model, the sell model, and reverse all the information for the market maker buy model. I will come up with live chart example shortly, and after that I will try to give all the information in one single video so that you guys can get the key points out of it. So I will try to make it short, less informative, but the key informations out of it. Okay, so with that, I wish you all the best and all the success, and see you with the live chart example where we can look for the entries or where price has delivered according to a market maker model. So until next time, take a very good care of yourself, your health, and your loved one. Bye bye.